external debt is in average 1%. But with by the foreign exchange loss, basically that risk. So nearly we found that 4.5% that kind of markup is needed. Therefore, the cost of borrowing, basically in the sense of the interest rate, seems more or less same in over time. So it seems like that, Andre. Am I clear?
I think I partially understood. So you're saying that the interest rate is more or less in line with what you would expect, but I couldn't capture the last parts of what you said in terms of the external of the interest external.
The external debt while paying over time, for example, nearly they are long term. We found that due to the depreciation of the Nepalese currency, in spite of being a very low interest rate for the concessional loans, while making repayments with the depreciation of the Nepalese rupees, the cost of borrowings in overall by repayment of the principal and also payment of the interest, the cost ultimately come nearly up to the 4.5%. So that kind of scenario is over there. So we also have to treat the domestic debt instrument also diligently. That was my point, Andre.
Yes, correct. So I would suggest you to. So first thing, I think we are ready to start to putting together this document, which will be the debt strategy. So I sent you a couple of examples in the past. Yeah. So you said that you would like to present this to whoever you need, maybe your the cabinet or the minister or other peers in the government in November, right? So I think that right now we should be focusing on two things. First, to check on this, what do you really expect in terms of disbursements and also what do you expect to raise in the domestic bonds? Because, for example, I was saying if you read carefully my email, you would say that for the domestic debt, the stock is about of T-bills. It's already 210 billion NPR. So typically, I think what the Rashtra Bank would do is to roll this over. But the splits that we are looking at is, for example, for strategy one, you would have to rely mostly on 70%, about 70 to 80% of the strategy, just to keep the same nominal amount existing there. Did you see what I'm saying, Prajo? So these numbers they were computed. If you look to the formula, it's just like what is 210, which is the existing stock, over the remaining split of what will be the domestic contribution to finance the gross financing needs. So this 293 is just this 46%, which will be the complement of this. So 46% times this, the gross financing.
Yes, I got it. Yes.
Yeah. So I think this is what you need to do, just to go through this and check if this makes sense. So it's not about the design of the strategy themselves. I think they are fine in terms, at least strategy 1 and 2, which are saying, okay, for strategy 1, I just want to do the same. So And the same would mean that your T-bills, so the disbursements are calibrated here, which is already happening. We are midway, like 1/3 of the fiscal year is already gone. And for the external, for the domestic debt, let's say we're just rolling over the T-bills and now introducing a little bit more of these other bonds here. And then you can accommodate, as I just did, the 3 years. And so this is what you need to do to check on if these percentages are realistic in terms of the nominal funding that they are providing.
So I just wanted to clarify, like broader in strategy level, we are good with what we have defined, all the 4 strategies. Maybe on strategy 4, we can take something very extreme point just to check the outcomes. We have to confirm with the final numbers if those numbers are realistic enough or not. No. So broader strategy level, it's good.
Correct. Correct.
Yeah.
And we can even tweak a little bit more on strategy 3. I would say strategy 3 and 4 to exaggerate a little bit more because we want to create variation. So you can be more reliant on, for example, Exim banks. Yeah, can you hear me?
Yeah.
So you've got that right, Prajal. I mean, I would even perhaps create further variations in strategy 3 and 4. You can exaggerate more here, and even more. So,
what do you suggest for strategy 3, Andre?
What I'm suggesting is that for the external borrowing, for example, you can. We want to create some variation, so you can actually, let's say, introduce non-concessional variable. Let's say, imagine that this is going to be big. Instead of using, let's say ADB, for example, let's say this is going to be this, and this is going to be 0, 1, and 2. Just to exaggerate, let's say now you're provoking some increment in the costs here if you are to be financed heavily on non-concessional variable. Because you want to say, what kind of risk is this strategy imposing to me? So you see what I'm saying? So I would not only exploring, and then you can even exaggerate the exploration of Exim loans. So for example, you can even change a little bit more here and there. So save strategy 3 and 4 to exaggerate and more, even if you don't think that's pretty realistic, just to be more aggressive in the transformations on your portfolio for illustrative purposes. Okay, so this is a part of your homework. And the second part, I think it's also, we already got it to see if these are realistic or not in terms of the nominal amounts that they are producing. So I think I tried to describe the rationale behind this of all of these strategy 1, 2, 3, and 4. So the other homework would be to start putting together the document itself. So I am fond of being very simple and very straightforward in the strategy document. It doesn't have to be big. I think we just need to describe what we've been doing. We have a session describing the existing debt. I think we already got this from this report that we are also producing. So we can easily just get the highlights from there, 1 page of explaining that. Then we go, we can also say something about the strategies themselves, why we are designing so. And this would be this other section of the document. It would be pretty much similar of what I've described in the email. The email, you say, look, the operational target is this. for that strategy, and then you describe why you're choosing this instrument mix, so on and so forth. So, for example, Mr. Babram enlightened us today with saying, for strategy one, the government is looking more carefully into issuing more three-year bonds, and then we would go along with these lines of saying that this would be the first step to lengthen the debt in the current circumstances. Then you want to say that this is complemented with 3 and 10 years now that we changed. You basically go along the lines that as I described in the email, but adjusted to the numbers that you see here in the spreadsheet. So it's nothing really magical. It's just to describe what you're doing. So you do this for all of these strategies. You describe the operational target, and then we fill out the document with the numbers, which will be I'd say 3 or 4 tables. I think this table is the most important one. And then we would populate also with the graphs, and that will be it. So is that clear what I'm suggesting? The second, we start to put together this document as well.
Yes, Andre. Yes.
Andre, can I jump in?
So you do, yeah.
Yeah, I just want to compliment what the Andre talked about, and I understand the nature of the Nepalese the existing instrument, especially the external instruments is the terms and conditions are very similar. Andre, can you go to the existing debt sheet? And because the old instrument is very long term, I mean the over 30 years for the first the extra can go up to a bit. Yes, the instrument number 2 to instrument number 6 are very similar because the maturity years is above the 30 years and have a long grace period. All currency are denominated in US dollars. Also, the interest rate are very similar from instrument number 2 to instrument number 5. It's about 0.75 to 1 point something. Even instrument 6 is a variable instruments. The overall cost is about 1.6 or 1.5 or something. They're very similar similar terms and conditions. So in terms of cost indicators such as interest payment to GDP or interest payment to revenue, so the changing the share among these external instruments would not bring a big change for the cost indicator. However, in terms of risk indicator, if you want to increase a share for concessional variable instruments, that would make a big difference. However, other than that, in terms of cost indicators, due to the nature of these accessible, feasible instruments for the power, so that would not bring a big change in terms of cost. So that is my observation. So the main big difference comes from the domestic side. How much you want to increase the domestic share, or how much you want to increase the longer term bond, or longer term bond would more significant impact on the result of cost risk indicator results. So that is my understanding. Just for your information.
Yeah, that was very well said, Yudo. And so this is why we're not so surprised with the little variation in terms of the cost that we said. And perhaps another way to impose another source of risk would be to do this to further calibrate the devaluations of the currency here. So I already did this in the shock scenario. So if you also look at it somewhere here, I think it's on the right hand side. I kind of exacerbated the shocks. So just for us to that we would see the shocks of the depreciation of the currency. We can be more aggressive here if we want to create more variations as well. But I did for 30% in the first year and 60% for the extreme shock, so on. This set alone. So we would also have to describe this the macro and market data on the strategy. So I think this would be what we wanted to discuss with you today, just to reinforce what was the rationale of how you can tweak a little bit this strategy. We know that you guys are on a holiday, so we don't want to overburden you and to spoil your celebrations more than we are already doing. So.
May I ask one question to you, bro? Was he focusing on to also incorporate the instrument that are variable rates? Am I clear?
Sorry, could you say that again, please? Sorry.
Are you telling that it will be better off to incorporate the instrument or loans with the variable exchange rate?
No, I mean that. Well, what can I say? Yeah, I think that the broadly your calculation so far is good. I think, but as the Andre mentioned earlier, that the result is less different, less indistinguishable, especially between the strategy two, some strategies. So that is because especially due to our nature of your feasible accessible the instruments. So I think that's the actual situation, real situation. So I think that is fine. But if you want to see, how can I say their more for education, I don't know, for educational purpose, for I don't know, for internal
illustrative purposes.
Yeah, for illustrative purposes. Yeah, you can increase the share of variable instrument number 6, which is a variable instrument, so that you can distinguish in terms of risk indicator, such as ATM or ATL would have a big difference compared to the other strategies. So that is one option you can take. But I would not. I did not say that you should do that or you should do that. That's one option. You can just you can present one of exaggerated as a strategy.
Yeah.
Okay.
So
Thank you.
So it's just it's the same thing that we were. It's the same thing that we were describing here for let's say strategy 3 and 4, to play and to exaggerate a little bit, even if you're not willing to do that, just to see what would happen. So the main goal of the MTDS is to answer what if questions. So what if we all of a sudden rely more on variable, non-concessional? And then you would see. So this is, again, exploratory to fully take advantage of the exploratory nature of the exercise. Yes. Another question?
Yes. I just have one query. Like we for foreign exchange depreciation, we are considering USD only. Almost I think almost 80% of our debt is denominated in SDR. So is it okay if we just see if we just check the forecast FX depreciation on the basis of US dollars only, or we need to incorporate other currencies as well?
ideally you would break down into the bundle of the other currencies that form SDR. But then you already described the existing for this to make any difference in the portfolio, you would have to also make a split of all of these instruments into the different currencies, because if the way that we are putting together the sheet is understanding that everybody's at USD. That's why we are focusing on the macro devaluation only on the USD. However, I think for simplicity, it's fine to have the only USD because there is a strong correlation between the dollar, the euro, and the other currencies that mostly form the SDR. Would you agree with that, Yudo? How do you do this in the DSA side?
So I think, because the main currency in STL, I think that it accounts for 40% or less than, nearly 50% is US dollar, and the second currency, the euro, I think it's 30% or something. So as Andres mentioned, that the main impact basically coming from the US dollar, but if you want, I think you can add euro, the shocks from the euro, and so for both those US dollar and euro, so almost 70% of shock can be from the SDL can be explained. So but it's kind of how can I say that cost and benefit due to doing these things. So of course, to incorporate all the breakdown to all currency is more accurate. But from the simplicity and from simplicity, I think the first line is US dollar is fine. I think still fine. But if you want, I would suggest to include euro depreciation shocks from euro or euro. So but
Yeah, I mean, I see no harm in filling this out with euro and the other currencies. Perhaps you can ask.
So if
you can ask the NBR.
if we have, sorry, Andre. So if we have to add one more currency, then we need to present that the instruments in other currencies as well. Instruments need to be denominated in euros as well, no? Or we can just add the numbers over here.
Yeah, that's what I think. I think this wouldn't make any difference. Yes, you are. I think you wouldn't make a difference unless we change also the instruments here. So because everything is either USD or NPR. So I would say that because you're not denominating any instrument here as an euro, then you would have to, and I think it would be less straightforward if we say ADB, OFID fixed in USD and euro, because as I said, if you plot the correlation between the two currencies, they're almost one, the correlation coefficient. So they go up and down very closely. So I would say that even if we fill out for euro here, which I see no harm, it's fine. But unless it wouldn't make a lot of difference because we are not labeling that instruments for the strategies that are dependent on euro. So
that's great. That's right.
Yeah. So I would say that for simplicity, I wouldn't really touch that. We can also describe this in the write-up. I think a lot of other countries they do this by the same fashion. For example, it's different if you were to have a European fund disbursing straight into euro. That is different, which is not the case. So I would focus on the other things instead, Rajal.
Yeah. Okay. Sure. So one more query, Andre. The Bavram sir just said that we have higher level of foreign exchange risk than interest rate risk. So can we introduce more indicators to incorporate this foreign exchange risk, or this too will be fine for us?
I believe the foreign exchange risk is well reflected when you look at the percentage of the external debt resulting as compared to the total debt. So, for example, this existing debt here, which is our X-ray machine. If you look to this share here, it will always be an indicator, and also the foreign exchange debt share as percentage of reserves. These are the main indicators. So if you look to the summary results, this line is also replicated there. Yeah.
If I may, I would suggest to refer to the redemption graph, which is in the redemption by FXDX. So you will see the redemption by the currency by currency, external and domestic, and it is very illustrative to bring to a very useful information from the visual information from the graph when the huge amount of repayment would happen, or this kind of information can grasp from the redemption profile. So I would suggest to paste that graph on the in the document.
Yeah, it should be here, right?
It's redemption. Yeah.
Exactly. I mean, we can explore. Once we are fine with the numbers in terms of the nominal, disbursements that are plugging into each strategy, especially in the external debt, this will not change much for strategy 1 and 2. Let me repeat this. These numbers, I think for strategy 1 and 2, you really need to focus on what's happening in terms of nominal. So how much do you expect to raise to be disbursed with these instruments this year? So you find this with either the FCGO or with you or with the other office, which I forgot the number and the name, that negotiates this with the external financiers. So you basically transform whatever is going to be disbursed this year into percentages of the gross financing needs, and then you do the split, and then you do the same for the domestic debt, and that's strategy 1. For the strategy 2, I would basically keep the same rationale, basically saying that you're now going to spend some more time, some more funding coming from from IDA instead. Let's say that in this fiscal year, because of the crisis itself, the IDA is going to be more active. The bucket is larger, and then you do it the same. And then the residual you split into these instruments for the domestic. And once you do this, then 3 and 4 we can be more creative. And then we're gonna look to these risk indicators and how they're gonna play in. So is it clear what you need to do, Prajal?
Yes, Andre.
Yeah.
Only thing, there is regarding the exchange rate risk, the as you know, we have pegged with the Indian currency, and the depreciation of the Indian currency is very high for these days. So, is there any studies regarding the pegging of the Indian currency with Nepalese currency with World Bank or IMF over there? The potential impact of that one.
This is an excellent point. Yeah, sorry, go on.
Okay. Regarding the exchange rate risk, the one of the factors for that risk is the pegging of the Nepalese currency with the Indian currency, because the depreciation of the Indian currency in for last 12 years is consistently with the US dollar, consistently increasing with the US dollar, the depreciation of the Indian currency. Our exchange rate is pegged with the Indian currency. How can those kind of risks can be addressed in our strategy? Is there any studies?
Yes, this is a very good point. What you could do is to I have to think about this, but I think my initial reaction would be that you can actually provoke some depreciation of NPR here that would be replicating the Indian rupee. Would that make sense for you, Yudo?
No, sorry, I could not understand. Kindly repeat.
So I have to think about this a little bit more, but I think my initial reaction would be the following: if we all of a sudden we decide to introduce that, you see this line here, it's NPR. So basically, we would consider that NPR is just like the rupee, and then you could say, no, that doesn't make sense. So I would say that for the strategy, for what would make sense is because your revenues are also denominated in NPR. So that's and the amount that you raise is also in NPR in funding. So what you could do instead is say, look, the depreciation of the currency. I think this is actually what I did. This is reflected here because the Indian rupee, I consider that the Indian rupee is represented in the depreciation between your currency and then. So when you see this line here, this depreciation is the expectation of the rupee changes in the future. So this is already reflected here, Mr. Babur.
Yeah, I think so. So if you see the line 91, which 92, sorry, US LPL exchange rate projection, which is based on the exchange rate depreciation projection above, and yes, the US LPL is 16.5 according to the depreciation projection of 2021. And also, if you look at the line 97, which is line 96 in Indian rupee and LPL, which is completely one over the period. So I think the impact from the depreciation between the US dollar and the Indian rupee has already reflected in the line 81, which is USD depreciation. That is my understanding, Andre.
Yeah, correct. And I remember now that, it's been a week that I don't do a lot of things that went on. So I remember looking at the Bloomberg terminal and using the foreign rate agreements of non-deliverable swaps between the dollar and the Indian rupee, because they have a very active market. So I projected based on that. What you could do, Babru and Prajal, is ask the NRB or the fiscal area within the Minister of Finance, what are their expectations and of the depreciation, and fill this out accordingly. So you don't need to.
The different issue I may not be raised over here. My expectation from you is that if there were such a kind of inferences with other countries also who have paid their money to the other countries, and those kind of experiences with them, how they addressed such a kind of problem, could be useful for us. That was my point. Thank you very much. Of you, in short run, we cannot address this one. So, but it is the days are coming that we have to rethink on that side also. So it will be the one of the policy issue also. It is not that much easy. Let's focus on the DC strategy first, and we have to confine within November. So we can proceed ahead over there on this side, because we want to consistently work on even there are holidays over here. After holiday, I will ask Parjol and my team at the policy unit to sit together and go one by one in every strategies and instrument over there. Before that, the Parjol and myself will be working on in detail. Okay, kindly proceed, Andre.
Very well. So I think, I don't have. So just to address quickly on your question on the pegging regime, I think it's something that you could discuss with Kenny in another occasion. I mean, I think they have a lot of conversations. I see that this works for some countries. For example, we're just working with your neighbors, Bhutan, and it seems that the pegged regime serves well the structure of the balance of payments and the liabilities that they also had there in the external, in the public debt helm, public debt area, because they have a lot of a lot of agreements with the government of India that has a huge impact on the debt flows, but also in the assets that they have with SOEs that are basically account for most of the debt, and also the assets that will be the stream of assets that is going to be used to serve the debt. So in a nutshell, for them, the pegged regime has more benefits than negative sides, and then that's why it's going to be preserved. In your case, I don't have an educated answer because I don't know the structure of the balance of payments. So this is a topic that you might want to bring later at a later stage with Kenny and the economists that follow Nepal more closely. And yes, so now changing subject. Let's focus on our homeworks, which is two-folded, and then we reconvene you next Friday. So that will be all from my side. I think we are progressing, honestly, and we are now, let's spend our time and our energy to zoom in, to zero in this, and to produce the strategy document, which will be our main goals for the next 2 weeks. So let's say, hope that we can draft this in 2 weeks' time, which will be in the middle of November.
Andre, regarding the coming Friday, we will, I think, based on the other collided activities, we will skip the meeting on coming Friday. We will meet after the next Friday. Before that, We will work in detail and share your document over there for your feedback through email. Maybe I may be out of the Kathmandu Valley for next Friday. So I'll request you to schedule the other Friday. Before that, our correspondence and update will be continued. This is my proposal. Is it convenient for you?
It is fine with us. So you're proposing so we would reconvene on November the 6th.
Yeah.
Is that fine? That's what you're suggesting?
Yeah, because
So
we have.
two Fridays from now.
Sorry.
It's November the 6th. So it's the date that you're proposing, 2 Fridays from now.
Yeah.
Okay, I will let Anima know. So she will send the invitations for everybody's email, your Gmail. So yeah, it's fine with us.
Okay. पर्जलजी केही छ अरू क्लियर नभएको कुनै विधाहरू
Andrew, can you please share me that interest rate projection file you prepare? Excel file?
Yes. The old one that is specific on interest rates, right?
Yes. Yield
Yeah, I can do that for
prepare the
sure.
yield curve, yeah, June forward. Yeah. Thank you.
Sure, I'll send you.
Andre, I have one question again.
Sure.
As you know, in the data that the rollover, the level of rollover in T-bills is high in that data. There are basically two reasons. In past, the while making repayments, they were not properly